This is Bloomberg Intelligence.
Usually when the consumer's under pressure, dollar stores do really well.
We still see R&D spending for the big biopharma companies holding steady.
In-depth research and data on 2,000 companies and 130 industries.
The one area that Netflix hasn't yet ventured into is sports.
As dominant as PepsiCo is, it can even do better.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to hear about private credit, which is poised to continue growing.
Plus, can life insurers keep profits up thanks to a favorable post-pandemic landscape? All right, let's take a look at European Airlines. Our next analyst suggests they should prepare for a bumpy 2024. The post-COVID travel boom is over and costs remain high. For more, we're joined by Bloomberg Intelligence travel, leisure, and retail analyst Conroy Gaynor. So, Conroy, talk to us. I thought people are still kind of going crazy doing all the vacations and stuff like that and getting out of the house. But what do you expect for the airlines next year?
Look, we're definitely seeing a story of strong demand in the short term. You know, if you think about some of that pent-up demand where people were locked up for 2 years and, you know, they're still willing to spend money on travel and sacrifice other things to travel. Now, the issue is that, you know, as we get further into 2024, we think some of that pent-up demand unwinds. We think that some of the sort of threats to household budgets start to intensify. Particularly think about sort of softer economies and interest rates, particularly affecting mortgage payers in the UK. So I think there might be the demand will still be strong, but you know it's not going to step up from where it is already now.
Where are we in terms of business travel? I think here in the States, most of the airlines are saying leisure travel is back to pre-pandemic levels, but business is probably still, 20, 25% maybe below pre-pandemic levels. What are you seeing over in Europe?
Yeah, I mean, it's the same this side of the pond. It's be around about 70-75%, and it stayed there for a little while, actually. So it seems like it may have settled at around that sort of level. Now, I think what's interesting, listening to some of the airline commentary, is that the work-from-home culture does have an effect on business travel. So if you look at, say, British Airways, the business travel has settled at a much lower level than, say, Iberia. But, of course, in that part of Europe, there is less of a work-from-home culture, so the people are still more willing to travel and do business rather than, sit on a Zoom call.
All right, so that's the top line. That's a revenue part of the equation. How about the cost side? Is there challenges there?
Yeah, I mean, well, I've given up trying to forecast jet fuel because that's very volatile and all over the place. I mean, of course, there's some risks there. We talk about geopolitics and some of the conflict we have in the world. Jet fuel it really did spike after the invasion of Ukraine. Right. Came back down again, I'd say, in the first half of 2023. Then it spiked up again. Now it's softening again. So, I think hedging is quite important to sort of know where you stand, at least in the short term for an airline. But I'm a little bit more concerned is that I still think some of these labour shortages putting pressure on what we call the non-fuel unit costs. And that seems to be a bit more structural in how inflation seems to be quite embedded in that. Shortage of pilots. Obviously, they're going to then try to bid up their wages.
Right.
In air traffic control. So, I do think that inflation could be here to stay for a while in European aviation.
How about consolidation? I know, kind of the carriers over there are kind of divided between the legacy carriers, the Air France's and the Lufthansa's of the world, and some of the low-cost carriers like Ryanair. Is there any expectation that there could be some consolidation within the airline space? Yeah,
I mean, this is. I think this is a little overdue in Europe. So, when you think about the US, the market's really dominated by, say, 4 players. But of course, in Europe, there's cultural reasons, there's different countries. Consolidation just hasn't happened in that way yet. But, we do think some of we don't think it'll ever reach maybe the level of the US, but we do think that there will be. I mean, we're seeing it already. So the 3, could say, deals that are being sort of done and sort of finalised in 2024 is that IAG wants to buy the rest of Air Europa. It already owns a 20% minority stake, wants to buy the rest of it next year. That will increase its position in Spain, also transatlantic. You've got Lufthansa, which is in the process of buying 41% of ITA Airways, the sort of trouble Italian carrier, and then you have Air France KLM is involved in a rescue deal with the bankrupt SAS, so expect that one to go through as well. And then one that's not necessarily in process but is up for sale is TAP Air Portugal.
Right. Yep. Okay.
All three of the players I've mentioned there, all three of the big players, IAG, Air France KLM and Lufthansa, are interested. So they've thrown their hats into the ring. So we'll wait for the next steps on that.
Interesting. All right. Very good stuff. All right. Thanks to Bloomberg Intelligence consumer analyst Conroy Gaynor. Let's turn now to the U.S., which is also seeing softer demand. Here to discuss how that's impacting the industrial sector is Bloomberg Intelligence senior industry analyst Karen Ubelhart. Karen, talk to us about, I love your sector, American Industrials. Give us the 30,000-foot kind of 2024 kind of outlook here.
Well, I think it's going to be a year of picking your spots. There are some weak sectors, but there's also going to be a number of pretty strong ones. Aerospace is going to continue to be very strong on both the OEM and the aftermarket side. Anything related to some of the federal spending bills is going to look better, like rental equipment, HVAC. They should see growth. And construction, which is the area that people are most worried about because it's interest rate sensitive, is going to be a mixed bag. The traditional construction is going to see some softness. The money from the federal government is going to it's already surging in infrastructure. It's going to surge with the IRA and the CHIPS bill in 2024. So I think it's going to be bumpy because people are going to periodically worry about whether the traditional construction is going to drag it all down. But there's a lot of money that's going to be rolling out. It started this year. There'll be more next year.
Let's talk about that money from the federal government. Is that like next year shovels in the ground kind of spending money, or are these planned spending money?
The infrastructure spending is already in the ground. They're already seeing a lot of demand because that money came a year and a half earlier. The IRA, it's really just starting, and a lot of it is tax credits. On the consumer side, you'll get an $8,000 rebate if you buy heat pumps. That stuff is not implemented yet because of federal bureaucracy. It takes a year and a half to get all the parts in place. Ashted reported, and they said there's $692 billion of private projects on the board or underway.
Wow.
That's a lot of money. That's not money. Fed. That's private.
Private money. Okay.
They'll roll out over number of years. But
how about just a weaker economy, a softening economy, whether we have a recession or not? If a lot of the data suggests that the economy is slowing down, how does that impact kind of industrial America, generally speaking?
People will be more cautious this year on the cost side. They are anticipating anything consumer exposed, like companies like ITW and 3M that have consumer exposure are already seeing softness in some of their markets. I think everybody's watching carefully, but they really haven't seen much of a weakness except, as I said, in the consumer market. So they're preparing, but a couple of other things are going to be better. Supply chain's going to be better. The backlogs are very good. Prices will normalize, but there's a number of things that are going to help them along the way. But they know it's softer in spots, so they're watching.
Are the companies lean enough? Like, have they trimmed all the fat so they're like ready to handle something that comes their way?
I think so. I think the thing that has happened this year with organic growth rates slowing, margins are still really good. They're holding up, and a lot of that is the cost cutting and pricing. And if we go in downturn, there's always some volume related cost cuts. But I think the big secular cost cuts they've done and put themselves in place for a downturn.
All right, I'm looking at your report, your research report, 2023 BI North American Large Cap Year-to-Date Price Return. I am shocked to see what's at the top of the list. General Electric. How long did you and GE shareholders have to wait to see that?
2018 is when Larry Culp joined, and it went down for a while before it went up. The split is getting close. It's going to be they're going to split the energy and renewables businesses from the aerospace business.
Because I want to own the aerospace.
Yes, you do, and that's what's running the stock.
So Honeywell is doing the exact opposite. Like, they're keeping it all. They redesigned their business into 3 buckets, but they're going to keep the 3 buckets. Do we know if that's going to be the right strategy for them?
I think that's part of what's hurting them right now.
Yeah.
Because, as we know, these things come in waves. And the last couple of years, it's been focus. People are dropping businesses. All the HVAC guys are now pure plays, except for JCI. And you've seen, and Honeywell has decided we can do well this way. And it's hurt them. But I think over the long run, they will. If we get it, as things slow, they're going to hold up better than some of the other sectors. But I think at some point they may feel the pressure to do something.
I feel like with that, with all the stimulus money coming in, just overall, your sector, you can feel pretty good about it, right?
I do. I'm not nearly as worried. I've been through an awful lot of cycles. And there's good ones, there are bad ones. They're all different. But we've never had so much money coming from private and public concurrently.
Are the stocks rated for that?
Actually, no, because broadly, their valuations are actually below a 5-year average in most cases.
So,
not individual stocks, but as a group.
So what's up with that?
People are concerned. I think generally investors think it's going to be the same as it was in the past rather than it's different, right? They don't believe that it's different this time thing. So it has to be tested. We have to get through a couple of slow quarters. If the companies hold up, you're going to see a change in sentiment. Yeah.
Literally, Karen is the most awesome person to talk to if you're talking industrials. We love talking to Karen. Karen Ubelhart, Bloomberg Intelligence Senior Industry Analyst.
Coming up on the program, will computer hardware companies get a lift in 2024?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Computer companies can look forward to a recovery next year after prices and sales bottomed in 2023. For more, we're joined by Bloomberg Intelligence Senior Technology Analyst Woo Jin Ho. Woo, thanks so much for joining us here. Talk to us about the cyclicality of the global computer hardware and storage space and kind of how that might set us up for 2024.
Sure. Thanks for having me on the show, Paul. So over the past couple of years, as many people know, that we've actually been on a down cycle for not only for the PC and the smartphone space, but also on the server space. One on the PC and smartphone space, there was an anticipation of consumers buying a lot at the peak of the pandemic. That never materialized, so there was an inventory glut that the vendors had to work through. And on the server side, there was a capacity glut because companies bought up a lot of capacity during the supply chain bottlenecks. And there was a couple of quarters or several quarters of down cycle, and I think we've finally gone through the bottom of the cycle. And as we head into 2024, we should start seeing demand pick up again.
All right, so I know in your space it's servers, storage, PC, smartphone. Is this going to be a unit volume growth, a pricing? How do you expect that to kind of play out?
Sure. It's actually going to be both, right? From a unit volume standpoint, I think we are going to start seeing a pickup in unit volume as capacity starts winding down. Now, the one thing I'll caveat this by saying that on the enterprise side, I do think that servers and storage are going to lag on the PC side a bit. Because they're a little bit later into the down cycle than PCs. But from a pricing standpoint, we have AI actually driving pricing on the server side in particular. The traditional AI server is about 10 to 15 times the price of a traditional server. And the reason is you're loading it up with all of these NVIDIA GPU accelerators, and that's going to boost up pricing and also help the gross margin dollars for the service vendors like Dell and HPE.
So is AI, I mean, we've heard so much about AI. Is that meaningful yet to your part of the hardware and technology stack?
Not yet meaningful. So let me give you an example here. We're talking about $3 billion in orders for HPE in their most recent quarter. They have about a $50 billion revenue base, right? And orders don't necessarily mean immediate revenues. So, near term, I think it's going to be a positive influence. But there's this dynamic going on where AI servers are actually cannibalizing the demand for traditional servers. That's probably going to take a couple of quarters to work through before we start seeing overall growth. I do find that 2025 is going to be a good momentum year off of 2024. So we're going from growth in 24 to potentially better growth into 2025.
So how much are your companies impacted by just the overall economy? It just feels like IT spending is something you just got to do. It seems like the cost of doing business today. But there is some evidence that the economy is slowing down. I'm not sure if it's a recession, but certainly slowing economy. How does that impact your company? What are they saying?
Look, that is an overhang in the space. If we look at companies like Dell, HP, HPQ on the PC side, they're all seeing a slowdown in PC spending. The servers really haven't picked up as strongly as we had hoped going into the fourth quarter of this year. And it's going to be an overhang. It's going to be an overhang. But again, circling back to AI, because you get this average sales price bump on the servers on the storage side, there's this FOMO, this fear of missing out criteria. If you don't invest in AI, you are going to be at a competitive loss. And companies are going to invest regardless of the economy because they don't want to lose out to the competition.
How are the stocks doing? I mean, how's the performance been in 23, and what's the outlook when you talk to your clients for 24?
Well, you've had me on the show for a couple of times now, and I was talking about the PC space and the server space for quite some time now, and I've been talking about the bottoming, and investors have actually jumped onto that theme. It's the stocks in general, the sector in general has been up 36%, pacing with the Nasdaq Composite. So there is a recovery that's being baked in. But if we look at the forward earnings valuation for 2 years out, we're talking about 14 times. So it is trading at a premium to the historic norm of 8 to 12 times. So there is still quite a bit of optimism in terms of the hardware sector for the next couple of years. So
how much of that do you think is just, numbnuts like me saying, I got to get exposure to AI, so, gee, Dell's a name I know, HP's a name I know, I'll buy some of those things?
Well, if we look at the individual company multiples, in terms of Dell, we started to see the pickup on the valuation because of AI. HPE and HP have really not seen that multiple bump up as of yet. There are other companies on the AI side, smaller cap in scope, Supermicro, for instance, and that's actually tripled over the last year or so because of the AI bump. But if the larger cap names in the hardware space starts really getting that AI tailwind, you could possibly see the valuation expand there.
And what's the profitability call here? I mean, in terms of margins, how much do your investors kind of focus on that? And are they cyclical? Or do they kind of have some big moves?
Yeah, that's a great question. On the margin front, it's specifically to AI. It is to some degree it's gross margin dilutive. But if we're talking about gross margin dollars or operating margin dollars, that's going to drive down to the bottom line as well as cash flow. So there should be a potential cash flow boost across the space if AI really starts taking off.
So, a lot of tech industries, they generate a lot of free cash flow. Give us a free cash flow profile of kind of the IT, the enterprise side of the business, and then what do they do with the cash?
Yeah, not the sexiest free cash generating company. We're talking about anywhere between 10% to 20% free cash margin for these companies. Some of them are cash constrained in the sense of HPE. They are actually doing restructuring to get some more free cash and try to bring it back all to shareholders in terms of dividends as well as share buybacks. Other companies like HPE and Dell are giving back anywhere between 70 to 80% of their free cash flow back to shareholders. It's mostly a shareholder return story. I will say that Dell and HPE do have quite a bit of cash on their balance sheets, or HPE will have some cash on their balance sheets. So there is going to be some M&A activity that's going to happen in our space. That's
kind of where I wanted to go. How do you think that'll play? Because it just seems like if I have AI in my portfolio as a C-suite, I'm in good shape. If I don't have it, I feel like maybe I got to go out and buy it. I mean, so how do you think about M&A in just your space in general, the tech space?
So hardware guys are trying to get away from buy once or sell once and then book again type of model, the perpetual revenue model. What they're trying to do is drive more towards a recurring sales model. And what I do expect these companies to do to buy more software companies with recurring sales in mind. So it's going to be software possibly with an AI and automation bent that will complement their hardware to drive more recurring sales.
All right, that's it. That's what I like to call. Our thanks to Bloomberg Intelligence Senior Technology Analyst Woo Jin Ho. Coming up on the program, we'll talk about the continuing growth of private credit. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So private credit, those were like the buzzwords of 2023. What's it going to be for next year? How big can it really get? What are the risks in terms of regulation? For more, we're joined now by Bloomberg Intelligence Senior Banks Analyst Paul Gulberg. This is a really dumb question, but when we say private credit, what does that actually mean to the everyday person?
It's any kind of a fixed income investment that's not being publicly traded. So it's not just the credit side of the business, it's also the asset-backed finance, it's also a lot of investment grade, which people often don't think about when they talk about private credit. So there are a lot of aspects.
I mean, I think about it, there's private equity, which I think we all know and love, but now there's also private credit. Private credit, can you tell us, Paul, where did this market come from? Because this just seemed to explode over the last, 4, 5, 6 years.
Yeah, so the private credit comes from the old days of distressed investing and opportunistic investing that was kind of geared to very risky high-yield investments and so on. And now it expanded to encompass a much broader area, so like asset-backed finance, investment grade. There are a lot of aspects, and the banks are kind of stepping off a little bit, so giving a little bit of room for the private investments to go into the market that can generate excess spread.
There are lots of risks out there. One of them is sort of the nebulous, like in a big downturn, in a world where defaults rate tick up, or we have some kind of dramatic recession where liquidity gets really tight. This area of the market has never been tested. Is that true?
I don't think it's necessarily true. If we look at the loan by loan, the area of the market has been tested, and the loans do go into default. And from the perspective of individual investments, that's probably not dissimilar from the typical bank lending. They do lend to all sorts of different companies, some with better credit, some with worse. And the loans individually on the private side often actually positioned a little bit better than sometimes the banks because they sit at the top of the capital structures. They often have stronger covenants and so on. I think the biggest issue that people take with the market and the fact that it's not been tested is the lack of transparency because it's private.
Does that then beg the question of, is anybody monitoring these guys? Anybody regulating these guys? It seems like the banks are regulated within an inch of their life. But how about private credit?
Also, some parts of the private credit market are regulated. So take business development companies, for example. They do have regulation. They do have leverage limits and so on. Then in terms of private credit funds, they're regulated by the SEC as funds, but they're not really regulated to the investment point.
What does that mean? Like, will they? Could they? Would it crimp actual private credit lending, the pool of capital? What would be the result of that?
Well, so the argument from the regulators has been for more transparency, and there has been an ask, but our legal analysts think that a lot of that is not going to come to fruition, that a lot of what's going on in the private market is still going to stay relatively private. So that's my point number one. The point number two, if you look at the largest managers like Apollo, Ares, Blackstone, these guys, they might not provide transparency loan by loan, but they do provide decent amount of transparency to their investors.
And I'm just looking at your sizing out the market for us. It's really helpful. Assets under management, private equity, $4.9 billion. Private debt, only $1.4 billion. So this is really small relative to private equity. That's trillion, by the way, $4.9 trillion.
It's actually up to about $1.5 trillion or so. It is a smaller market. It hasn't been around for, as you mentioned earlier, for that long. But the opportunity set in terms of investable universe is actually huge. And we identified it at roughly $37 trillion across different asset classes. Wow. So there's a lot of ground to cover if they take some business from the other sides of the market.
Who are the leaders right now?
Kind of works in a different area. So if we're talking about more investment credit, asset-backed finance, and it's Apollo and KKR because these guys are managing a lot of insurance annuity money. If we're talking about the direct lending, Ares is probably the biggest fund out there with a lot of different vehicles, both in the U.S. and Europe.
I mean, just private capital in general, alternative investments. I'm just shocked, or not shocked, but I guess I am shocked when I think about the endowments, college endowments. They've really allocated huge numbers to just this whole alternatives/private capital business, haven't they?
They have. I mean, very often, typical endowments will put half of the money into the alternatives.
Wow.
But that's not the case for for a lot of other parts of the market that's not been there. So if you think of retail, and there are a lot of family offices, retail investors who can really benefit from that long duration investments versus the long duration capital needs. Mm-hmm. Retail is about 3-4% in alternatives.
But the math there is just so much smaller. Like, what do you think that people's alternative asset allocation into private credit will be? I know Blackstone is doing this. Is it Blue Owl that's also doing this too? There's a couple others that have retail-focused assets.
They are. Blackstone actually have the largest business development company out there that invests in private credit. That's with about $50 billion of assets.
If I'm an investor, do I just go to the big Blackstones, KKRs, or they're...
And Paul knocks on their door. He's like, hey...
Yeah, you remember me.
Can I get in on that thing?
Exactly. So what do individuals do typically? Are there ways for retail investors to get meaningful exposure?
So first of all, you have to be an accredited investor. You can't be sold to everybody out there.
I feel like I'm accredited.
Yes. So those investments are typically distributed through RIAs. So companies like Morgan Stanley or large investment advisors, they'll be distributing a lot of these kind of funds.
As the size of this market grows, what asset manager sort of has the most room to grow? And I appreciate that asset-backed security versus different, there are different areas of it, but in general, who has the biggest portfolio and the biggest bench?
Well, the biggest one out there is Apollo, with about $500 billion of private credit assets in all sorts of forms. Ares is kind of behind, not that far behind it. Blackstone as well. So there are a lot of managers. You mentioned Blue Owl. That's very credit focused. And then there are those who get it into the market. TPG just acquired Angela Gordon. Mm-hmm. So that's a purely credit business, which they didn't have. They were equity focused managers. So now they going to have a lot of private credit offerings.
All right, Paul, we appreciate it. A lot to get through. Paul Gulberg, Bloomberg Intelligence Senior Banks Analyst. Thanks a lot. Want to turn now to life insurance in North America, where the pandemic was a positive paradigm shift for that industry. Let's break it down now with Bloomberg Intelligence insurance analyst Jeff Flynn. Jeff, is this just straight up everyone got paranoid about dying and they bought life insurance?
Well, I think I think that definitely helped in some cases. Although we've seen those trends normalize a bit, I think the real big swing is really pretty obvious, not a big secret. Just higher interest rates are very, very positive for the group. It's really a paradigm shift just relative to the last decade where interest rates were just so low. And that's really basically adding investment income to their portfolio yield. So that had been sort of I would say a 2 to 3% kind of earnings drag the last decade. And that's swung now in the other direction to where it's probably a 2 to 3% tailwind. I guess I would also add that the higher interest rates just in general make life insurance products more attractive to consumers. They're able to put better benefits inside the life insurance policies, inside fixed annuities, pension transfers, whatever it is. I also think, I guess the one other thing that I think is going to turn out to be a positive, I think with the economy looking like we're headed towards a reasonably stable soft landing, I think that the portfolio risk for the group is actually relatively modest, given that they have about 96% of their fixed maturity investments in investment grade securities.
So you're saying that the credit risk, which I know some people are concerned about, just in general, to the extent this economy continues to soften a little bit, you're saying the credit risk is manageable for most of these companies?
Yeah, I definitely think so. I mean, I definitely think that that's the case, particularly in office. I would say that that's been an area that's been especially concern. And now the group does have quite a bit of office exposure, about $50 billion, but it's important to put that in context because it's only about 3% of their overall invested assets. And they're conservative lenders on those mortgage loans, and it tends to be at about a 60 to 70% loan to value ratio, so that they have quite a bit of room for the buildings, real estate to come down in value further before they would experience losses. They also just tend to only loan on higher grade properties, buildings that are more in demand. Mm-hmm. So I think that they'll be able to weather that for the most part.
How about the stocks? I mean, if we're talking about a paradigm shift here, at least over the last 10 to 15 years in terms of a higher interest rate environment, has that been reflected in the stocks?
A little bit recently, but in general, no. I mean, they're trading at around close to book value. Now, going back prior to the financial crisis, going back, 15 years, they tended to trade more kind of in the 1.2 to 1.3 range. And that's really a key part of the story because that's sort of correlated to their return on equity. And return on equities were actually pretty strong in the year to date at about 13%. But I think because of some of the factors we've discussed, like the higher interest rates, the benefits business, I think they can push up close to 14% over the course of the next year or two. That also reflects cost control has been a pretty intense focus for the group. We've seen some large programs from Prudential and Lincoln. I think they're well positioned to sort of take advantage of automation, artificial intelligence. Obviously early days for that, but they have a lot of data, a lot of underwriting data, a lot of data sets that they can leverage. They also have pretty high call center expenses, which I think can come down over time.
What are the names in this field? Like, how crowded is this field? I know, like MetLife.
Right, like MetLife. Corebridge is an interesting name. That was spun out of AIG. That was AIG's life insurance business. They've come out and are executing pretty well. They actually have a large cost program now. They're really levered to higher interest rates. They're a leader in fixed annuities. So that's a name I would point to. Prudential has also actually really doing a turnaround there too. Again, with a large cost program, but also they've been investing in some lower risk businesses in fixed annuities, and then they're also growing in their spread-based pension transfer business. And some of the smaller names that are growing, Voya is growing, Equitable is growing. So there's a I think a positive outlook for quite a few names in the group. They also tend to buy back a lot of stock. They again, that's sort of a focus on the return on equity. They have a sort of a pattern of repurchasing shares in general. We've seen the repurchase level; it's about equal to where it was in 2018 and 2019. So it hasn't really dipped. It's been through the pandemic and early in the pandemic 2021, it came down a good amount, but it recovered pretty quickly. So they're and that obviously helps to keep their return on equity higher.
What makes, from your perspective, Jeff, a good life insurance company versus a not so good one? What are the metrics that you look at?
Well, I think one of the key ones is return on equity. Anything sort of south of 10% is obviously is a little low. It should be more in the low teens range. I think also we want to look at premium growth, and this is sort of a function of some of the businesses that they're in, and that's really sort of a mix shift, sort of going into kind of benefits business. Some of them are asset management, some of the businesses that are growing a little faster. So I think some of your companies that are more levered to traditional life insurance may grow a little bit slower. We'd also look at RBC ratios, kind of the risk-based capital ratios. There you want to see something north of 400%, and that's really just a measure of basically how much capital they have relative to the regulatory requirement. And we have actually seen some companies. I'd sort of call out Lincoln. Lincoln had a very large actuarial charge in 2022 relative to their some universal block of universal life policies, and that brought their RBC ratio down to about 360%. It's since recovered a bit, but that's a very key metric. But I would say most of the group is in pretty good shape in kind of the 400 to 450 range, and that really is that's really key because if it falls down much below that, then it's difficult for them to do share buybacks, and that's a key driver.
Hey, Jeff, good stuff. We appreciate it. Jeff Flynn, Bloomberg Intelligence insurance analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.